Hello everybody and welcome to another instalment of our Finance Director's Update for November 2023. My name is Stephanie Henshaw. I am a partner and the firm's Head of Audit, and I will be talking today about financial reporting and some of the associated developments that as FDs you ought to be aware of. Now in this session we're broadly going to cover three topics. First of all, we're going to look at the proposed revisions to FRS 102, which we have discussed on earlier FD seminars. Secondly, we'll be looking at topical changes in legislation, just giving you an update on what's going on there. And then we're going to finish up by looking at year-end challenges, bearing in mind that we have quite an uncertain environment for financial reporting at the moment. So, starting with the update on FRS 102, there is a clue in the title here with a stay of execution. Now, you might remember from previous FD seminars that the FRC has been consulting on revisions to FRS 102. And that broadly has been focused around changes to the rules around revenue recognition and to bring leases on balance sheet, so in line with IFRSs 15 and 16. Now, when we talked about this on previous sessions, we said the FRC's initial proposal was for the revisions to apply to periods beginning on or after the 1st of January 2025. Now, that would have meant that the first financial year's reporting under the revised regime would be the 31st of December 2025 year ends. So practically, the work and the reporting would take place during early 2026. Now, the consultation period for the exposure draft with the proposals in closed at the end of April. And since then, the FRC has been considering the responses, of which there were 54, which is quite a sizable number, and they were generally quite lengthy. Now, the big announcement came in September, which is that they are not expecting to publish the revision until the first half of 2024. Now, as the start date for the standard, it is always periods beginning a minimum of 12 months from publication. The FRC has said that the new regime won't apply until periods beginning on or after the 1st of January 2026 at the latest, at the earliest. Now, that means that the reporting periods first effective will be December 2026 year ends. And I can imagine you're immediately breathing a sigh of relief at that point and thinking, good, that's 3 years away. I haven't got to think about it yet. Now, something to bear in mind here is there's actually a bit of a benefit in the delay, because originally we were expecting publication just before Christmas this year, in which case we'd have had a bare 2 years before we hit the start date, or before the reporting date rather. Because they've decided to delay publication until the first part of next year, it means we're actually going to get a bit longer to think about the impact of the changes. So do use that time wisely to do a proper assessment of what it means for your contracts in terms of how you recognise revenue, and also to gather your lease information. Now, moving on, in the meantime, we've also had 2 exposure drafts. Now, FRED 83, little bit of a minority sport, because this is related to the Pillar 2 tax legislation, and that is applicable to groups with a worldwide revenue in excess of 750 million euros. Now, the idea of Pillar 2 is that it's going to create a minimum effective corporation tax rate of 15% of profit across a group. So the size of the group you belong to worldwide is going to determine whether or not you're affected by these changes. If you don't expect to be caught, you can look away now. There is no impact on your accounts. If you do expect to be caught, you can ignore the provisions of Pillar 2 for the purposes of deferred tax. So under FRS 102, under FRED 83, Pillar 2 will only impact the financial statements when it hits the corporation tax return. However, for periods beginning on or after the 1st of January 2023, you do need to disclose if you expect to be caught by Pillar 2. So if you're a December 23 year end and you are part of a group that meets the Pillar 2 test, there is additional disclosure to give. In addition, you will also need to give qualitative and quantitative information about your reasonably estimated exposure, unless you are consolidated in the parent's publicly available accounts, in which case there's a big disclosure exemption. So if you're medium or large and exempt from presenting a cash flow statement because there's a larger group doing it, that may also mean you'll be exempt from disclosing Pillar 2, but you will need to say you've taken advantage of that exemption. Now, the FRED 83 changes have been incorporated into FRS 102, so they will apply to December 2023 year ends. The other exposure draft, FRED 84, deals with supplier payment arrangements. Now, there was a big spotlight on these following the Carillion scandal, because that was one of the areas which was causing a problem. Supplier payment arrangements are sometimes also called reverse factoring. Essentially, they are arrangements where finance house pays as suppliers on a company's behalf in accordance with normal credit terms, and the company then pays the finance house over a longer timescale. Now, there's nothing in company law or current accounting standards to trigger any disclosure about these arrangements, and they've very often been left as trade creditors, when in fact they're essentially a form of borrowing. Now, IFRS introduced a disclosure requirement earlier this year, applying to periods beginning the 1st of January 2024. So this is trying to bring FRS 102 in line with IFRS. Now, the exposure draft suggested implementation from the 1st of January 2025. But the FRC has since indicated it will finalise this standard in the first half of next year. So we expect it will probably apply to periods beginning 1 January 26, along with the rest of the FRS 102 amendments. So if you are using or considering using supplier payment arrangements, it will become apparent in your financial statements in due course. However, in the meantime, it is worth bearing in mind that there is one place in your annual reported accounts where you may need to talk about supplier payment arrangements if you have them. And that is in your financial risk management disclosures in your director's report or your strategic report, depending on where you put them. So there is an expectation there will be some information there. Now, moving on, thinking about changes to legislation, the big change that's come through in the last few weeks is the Economic Crime and Corporate Transparency Act. Now, that was given royal assent on the 26th of October. We know it is going to be implemented via secondary legislation, essentially through a series of statutory instruments. So none of the act is yet in force. We are expecting it will be introduced piecemeal because a number of areas require either additional guidance or changes to companies' house policies and systems, and they need time to get those in place. What we don't have at the moment is a timetable or any draft legislation to look at. But just as a reminder, the ECCTA really has three objectives behind it. It's to prevent organised criminals, fraudsters, and so on from using companies and other corporate entities to abuse the UK's economy. It's there to strengthen our response more broadly to economic crime, and also to support enterprise by enabling Companies House to deliver a better service for companies and to ensure it has reliable data. Now, I've picked out 4 areas in the Act which I think might be of interest to you. The first one is a new offence for large companies of failure to prevent fraud. Now, that is fraud by or on behalf of the business. That is not fraud being perpetrated on the business. Now, it's a strict liability offence, so prosecutors won't need to show that the organisation's leaders had authorised or even had knowledge of the fraud. The issue is whether you have attempted to prevent it. So what we're looking for here is for companies to have reasonable procedures in place for the prevention and detection of fraud by employees, by agents, by subsidiaries, and by anyone else performing services on the company's behalf. Now, we don't actually know what those reasonable procedures will look like at the moment, but I'm going to speculate a little bit because there was a similar requirement built into the Bribery Act. And there very much the focus was on businesses having to start with a risk assessment. So what is the risk of your business being used to commit fraud on others? And therefore, what controls do you need to have in place? What procedures do you need to implement to prevent that happening? Now, for anyone wondering what it counts as a large company, currently, if you have turnover over 36 million, total assets over 18 million, or employees in excess of 250, and you've passed 2 out of 3 of those tests, then you are a large company. So this is not going to impact SMEs. It is picking up large businesses. Other areas which are worth a mention, there will be a requirement introduced for ID verification for directors and persons of significant control, and also those filing on behalf of companies. Now, that ID verification is going to apply both to new and existing companies. So we expect to see some more information from Companies House on the practicalities of how that's going to work in due course. We're also going to have more scrutiny of company information and activities. So all companies will be required to have a registered email address, which will be published with Companies House. And also, a company's registered office must be a real address and not a PO box. Companies will apparently also be required to confirm on incorporation and annually that their business activities are lawful. Finally, in terms of better information on public record, that's really about the registrar's powers to correct errors. But one other point that is worth flagging under this heading is that new provisions will require small and micro companies to file their director's report and profit and loss account at Companies House. So this removes the abridged accounts and filleted accounts provisions which small companies have been taking advantage of. Now, I note there is an option in the legislation for the Secretary of State to make regulations such that small companies' profit and loss accounts are not published. But the reason for making the distinction is that if they're filed with Companies House, the registrar can see whether the business meets the criteria to be treated as small or not. And at the moment, that information isn't available. But retaining the non-publication of the P&L provides a measure of privacy around personal service companies where their profit is essentially the income of one individual. Now, moving on a little bit further, the size of a company is a key determinant in the extent of its financial reporting burden. And currently there's a whole range of criteria and thresholds, particularly for larger companies, which impact on narrative reporting requirements, additional reporting, as well as things like whether or not you have to do consolidated accounts or you are required to have an audit. Now, in June, the government launched a call for evidence on non-financial regulation to consider how best to streamline the reporting environment. What they're trying to do there is partly make sure users can make sense of annual reports so they're not too cluttered with non-financial information, but also to think about how the international sustainability reporting standards could be implemented in the UK. And that links through to the UK's ambition for a net zero aligned financial centre. So as part of the call for evidence, they were gathering comments on the various thresholds on whether they should be simplified. Now, what you've got on the slide here are the rules that currently apply. So on the left, we have economically significant entities. That's things like quoted or traded companies, AIM companies with more than 500 employees, private companies that satisfy both having more than 2,000 employees and either 200 million turnover or 2 billion total assets. That's called the weights threshold because that's the criteria that are used to determine as a private company if you need to do corporate governance reporting on the weights principles. And then there's a further threshold of having more than 500 million turnover and having more than 500 employees. On the right-hand side, we've got the financial and numerical thresholds, which determine whether you meet the definition to be a small or a medium-sized company. So medium first and then small second. Remember, those originate from EU legislation and so far post-Brexit have not been amended. Now, we don't know what the outcome is of the call for evidence, but we do know the government is quite keen to adopt the ISRSs, for example. What we also know is the EU has just closed a consultation to review its financial size limits for SMEs by 25%. So that would move the turnover threshold for the turnover upper threshold for a medium-sized company from 36 to 45 million based on current translation rates. Now, the EU is making that change for periods beginning 1st of January 2024. We aren't bound to follow what the EU does, but I do wonder whether the DBT will want the UK to lag behind in terms of competitiveness. So we might see some sort of change in the financial size limits coming through in the not too distant future. There's no indication they're going to change the employee thresholds. We've also seen a withdrawal of proposed changes to strategic and directors' reports. In some respects, that's quite a good thing because it was going to introduce yet another set of thresholds for which companies were affected. In other ways, not quite so positive because the proposals in that draft legislation were a response to the Bryden Review. Now, in fact, there seems to be no movement on audit and corporate governance reform. It was left out of the King's speech. The government has said it doesn't intend to bring any further measures forward. But it does mean that it is now getting quite difficult for the Financial Reporting Council to exercise its oversight functions, particularly in relation to directors, but also in relation to competition in the audit market. And if you remember, the Bryden Review, the Kingman Review, the CMA Review were all intended to address the results of the Carillion scandal and to try and create some more competition in the audit market. Finally, just a flag, if you have more than 500 employees and turnover over 500 million, or you're AIM listed, you are also now caught by the new non-financial and sustainability information statement. Now that applies to April 23 year ends onwards. If you think you're affected by that, do please talk to your regular Francis Clark contact, or alternatively talk to me. Now, finally, just a few things to think about in terms of year-end challenges, particularly if you are a December year-end. What are the issues you should be looking out for when you're preparing your year-end financial statements? Well, I'm going to focus on two areas, starting with the potential reporting implications of rising interest rates. Now, we have three particular areas where that becomes a problem. First of all, let's think about impairment reviews. Now, under both FRS 102 and IFRS, increases in market rates of interest and changes in market returns on investments are both indicators of impairment. And the reason for that is because they could materially change the discount rate that's used in assessing value in use. So if year-end interest rates stay where they are or even increase, it's much more likely that companies will need to consider undertaking an impairment review than they have done in previous years, because those rising rates are an indicator of impairment. Now, this is particularly going to be important for companies with intangibles or goodwill, but also longer term loans such as investments in other group companies or loans to other group companies, because those are the sort of circumstances where value in use calculations become very important. It's less important with something like property, plant and equipment, where you can normally identify a current market value and use that as your marker. Now, of course, impairment reviews require detailed consideration of future cash flows, growth rates, which may themselves need to be revised. And then, of course, you've got to apply a discount rate. With higher interest rates, it is likely that your discount rate will be higher, and therefore you're going to end up with a lower value in use. So there should be a harsher test there. So this is something to think about. Have you got the information together to do an impairment review, and what sort of result might it produce? If you report under IFRS, remember you also have to do disclosures around the sensitivity of interest rates or discount rates on your figures. Now, rising interest rates could also be relevant if you've been putting in place new intercompany loan arrangements. This is particularly important if the loan is not repayable on demand and the market rate of interest is not being applied. If a market rate of interest is not being used, then there is much greater possibility that you'll have to discount the loan to its present value, and that discount will result in a material adjustment. Now, I think it's worth saying you don't need to change the rates on any existing loans, only new ones. But do beware if you have refinanced within the group and changed funding levels. Finally, we are seeing more cases where there is now a surplus on a defined benefit pension scheme, not because the scheme is awash with cash, but because the fall in rates in the corporate bond market has increased the discounting on liabilities. So the liability is lower. Meanwhile, the assets the schemes are invested in, although they might have fallen in value, have not fallen by as much. So it's giving us lower overall liabilities, or in some cases, even a surplus in the scheme. Now, while defined benefit pension schemes are a minority sport, if you are unlucky enough to still have one, you do need to consider your position at the end of the year. And if you have a surplus, will that surplus actually be the entitlement of the company, in which case you recognise an asset, or do you end up showing nil or maybe a restricted asset in your balance sheet? Now, the practical point behind all of this is the implications for the year-end accounts. So first of all, which of the above issues might apply to you? How much complication or complexity will be involved in preparing the relevant information? How complex will the calculations be? How much time will you need to set aside? Will you need additional information, particularly in the case of a defined benefit pension scheme, because you may need to go back to your actuaries and request further information before you can make a decision about what to do? Because these are potentially material issues, it would also be good practice to prepare formal papers for the board to explain the impact of the numbers. The likelihood is none of these will be things which have been reflected in your management accounts during the year. So it's important the board understand where the changes in the financial statements are coming from. But also your auditors will expect you to have thought this through. We auditors, we can't do the calculations for impairment or in relation to discounting loans for you. You need to do that for yourselves. But there's a real impact on the quality and the timeliness of financial reporting processes if these sort of big ticket items are left till last. And of course, because they could be new this year, you haven't necessarily got an established plan in place for dealing with them. Finally, when you've worked your way through everything, you'll need to think about the implications for disclosure. There could be management judgments which are significant, and some of these amounts will be sources of estimation uncertainty. If you report under IFRS, the requirements around sources of estimation uncertainty are even more onerous than they are under FRS 102. So it's important you take time to think about what you need to say, get that disclosure right. Finally, we're going to turn to a topic we have covered on previous finance director seminars, but which still causes practical problems. So you can see on the screen here, we've got an unexpected item in our net current figure. Last year, we had creditors due after 1 year of 7.2 million. This year, all of that is appearing in creditors due within 1 year. So we've got a swing round from 2.5 million of net current assets at the end of last year to 3.7 million current liabilities this year. Now, why has that happened? Well, there are two potential reasons. One is because the loan is within 12 months of maturity, and therefore you have to categorise it as due within 1 year. There's not much you can do if you're intending to settle at the original date. But if your objective is to refinance again as long-term, then you might want to accelerate the process so that you've got a replacement loan in place which has more than 12 months left to run on it, and that will then keep the creditor sitting in due after 1 year. And that can be really important for the impact on your credit rating, your credit insurance, and with any other users of statutorily published information. Now, the other reason that loan might be sitting now in current is because the company has breached its bank covenants at the end of the year, and the consequence of that is that the loan becomes repayable on demand. Now, we get lots of questions about whether in particular circumstances, a covenant breach will impact the accounts or not. So we thought it might be useful to just do a quick revision of the broad principles. So if you breach one of your bank covenants before the year end, and that gives the bank the right to request its money back, regardless of whether it actually actions that or not, you have a covenant breach. Now, if you don't obtain a waiver at the year end, then you have to classify that loan as a current liability. If the breach is waived post-year end, it is a non-adjusting post-balance sheet event. And an important point to stress here is that if the bank offers you a waiver which effectively backdates the waive date to the year end, but the waiver itself is not given until after the year end, that is a non-adjusting post-balance sheet event, because at the balance sheet date, you were in breach. Now, by contrast, if you don't breach the covenant until after the year end, but you do it before the accounts are approved, that becomes a disclosure item. You are required to disclose the fact of the breach and how it's been rectified or whether it's been rectified. Now, again, this is a non-adjusting post-balance sheet event. So you're not going to change the classification of the loan on the balance sheet. In this instance, because the breach took place after the end of the year, you weren't in breach at the year end, so your loan would be classified as non-current. Coming down to the bottom left-hand corner, let's suppose that the board only realises post-year end that the covenant was breached during the year. Maybe you had a test date at the end of November and you didn't realise until you got to December that actually you had breached the one of the financial metrics. Now, the fact that you didn't realise it had happened until after the end of the year doesn't stop you having to report it as a breach during the year. And therefore, this becomes an adjusting post-balance sheet event. The getting of the knowledge then gets thrown back so that you do have to recognise that breach at the end of the year. And of course, that means that's going to create a current liability for your loan. Finally, you may not have breached at all during the year. You may not have breached yet, but your cash flow forecasts show you are likely to do so later in the financial year. Now, that has no impact on your figures or the classification in the accounts or indeed disclosure, except that breaching or potential breach of financial covenants could have an impact on your status as a going concern, particularly if you don't have any evasive action you can put in place to prevent that breach happening. Now, the really crucial thing with all of this is, first of all, what is the position at the end of the year? And secondly, if you are in breach before or at the year end, when did you get the waiver? It doesn't matter whether or when you report it to the bank. It all depends on the timing of the breach. Now, very occasionally, you get a covenant document which tests at a different date to the year end. And under those circumstances, it is possible that you may be able to avoid a problem at the balance sheet date. But if your financial covenants say things like test as at the 31st of December, then regardless of the fact that you didn't know what the position was at that point, because you didn't have your audit adjustments in place, you've still got a breach. Now, waivers can take different forms. You can have an unconditional forgiveness of a breach. You could have a suspension of repayment rights for a period of years or a period of months, or you could have a renegotiation of terms, which is conditional on the new terms being met. Now, if you've got an unconditional forgiveness of the breach, that's perfect. If you've got that at the end of the year, then you can't have breached anything. If you have a suspension of the bank's repayment rights, if they agree to pause, what matters is that they need to be pausing for more than 12 months. Because if you've got effectively a suspension of repayment for more than 12 months, then your loan is not due in the short term. But key thing, any waiver for a breach that occurs at or before the year end must itself be given before the year end to impact the accounts. Now, anecdotally, we have seen banks are less willing to issue waivers. We've also seen them less willing to issue relief for a prospective breach. So not being able to get them to agree to waive the breach at the end of the year, but wanting to wait until the information has come through. We have seen banks agreeing not to test covenants at a given year end. Now, that can be very useful. If they're not going to test, you can't be a breach. We have also seen banks saying they won't issue a waiver until they see the audited accounts, which creates a sort of chicken and egg situation and definitely doesn't get you out of the hole. Thirdly, we have seen banks issuing a reservation of rights rather than a waiver. Now, a reservation of rights is essentially the bank saying we're not going to pursue your covenant breach now, but we reserve our right to do so in future. The interesting question with this one is how long are they reserving their rights for? Because if they can't come after you for, say, 15 months, then you don't have a reclassification issue. If, on the other hand, they can come back any time from 3 months hence, then you've definitely got a reclassification issue there. Finally, do think practically when you're renegotiating covenants or negotiating covenants with the bank about the timing. It's much easier to manage potential breaches if the covenant checks are not aligned with the year end. For example, if they were October and January rather than being September and December. One thing to bear in mind with though is that you don't want to change your covenant testing dates and then have them land on a point where your cash flow is challenged, perhaps, for example, because that's when you pay your VAT at the end of the quarter. Because if you've got cash flow covenants, it could bite you there. So it does need quite a lot of thought to get the timing right. Now, I hope that's given you a number of things to think about over the course of this session. I am going to finish there. So thank you very much, everyone.